Amazon is up 55% in the last year. They are reporting earnings this Thursday, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, the growth of this company has been insane over the past 10 years, going from $74 billion to $554 billion. In this regard, analysts are expecting them to grow to $1,000 billion in 2028. What I like about Amazon is that it has multiple growth engines. AWS is doing about $23 billion per quarter and growing about 12% year over year. Third-party seller services is doing $34 billion and growing 20% year over year. Additionally, Amazon produces $10 billion per quarter in subscription and $12 billion in advertisement revenue. Therefore, Amazon is much more than just AWS and online retail. Regarding profit, looking at free cash flow, Amazon has made little money over the past decade with the exception of 2017 to 2020, where they reached an all-time high of $31 billion. Since then, free cash flow decreased due to an increase in capital expenditures, which has been high these past 3 years, as they have spent money on building warehouses, factories, machinery, etc. They are currently recovering with $21 billion in free cash flow, and I think the trend is clearly going up as capital expenditures are going to decrease, which is going to lead to more free cash flow, which is calculated by subtracting capital expenditures from cash from operations, and they are also growing high-margin sections of their business as we have seen before. Analysts are also expecting their profits to increase massively as they have them going from $3.69 this year to $9.25 in 2028. If you assign a 25 PE to the company then, it would make it a $231 stock, meaning 45% total return. Then, in order to calculate the intrinsic value of the company, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 13%, you need to pay these prices. I went with 13% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. The stock is currently trading at $159. Therefore, if the low assumptions occur, you are going to make a negative 8% annual return on your money, middle 7%, and high 19%. For my revenue assumptions, I did 8% annual growth on the low, 11% on the middle, and 14% on the high, which is around what analysts are expecting. For margins, on the low, I assume that the company remains with the same current margins, which are around 4%. On the middle, I assumed 8%, and on the high, 12%. I assigned a P and price to free cash flow of 21 on my low, 23 on the middle, and 25 on the high, and left the share outstanding change at 0% because the change over the past 10 years has been 13%, which is not a lot, and they have a share buyback program. The Excel spreadsheet does not address any value to the balance sheet, and this company has a very good balance sheet, as they have $64 billion in cash and $136 in debt, which is very low for a company that has a market cap of $1.6 trillion. In conclusion, I believe Amazon's profits are going to increase massively over the coming years. It's a fantastic company and has still a lot of growth potential. However, I believe Amazon is trading a bit expensive, and I am going to wait until it falls in price. I hope you enjoyed the analysis. Let me know what you think about this company in the comments, and I'll see you in the next one.